Welcome back to Strongman Personal Finance. We got a sponsored video today. That's right. And if you want a sponsored video where you pay me $50, or in this case, more because it's a long freaking video, see the pinned comment below, and I will do a video about whatever you want me to do. Check out my book, Stop Being a Broke Loser, too. Anyway, in this video, we're going to react to 25 tax strategies the rich, the evil rich, conceal from you. Now, or keep from you. Excuse me. So I don't know who Mark J. KOHLER is. I don't know anything about him, but I'm already getting grift vibes. Okay, these two individuals here seem like they got some sketchiness going on. Okay, maybe I'm completely wrong. Maybe I'm mischaracterizing this guy. I don't know who it is. Okay, but usually when somebody says something about, oh, the rich are keeping something from you. No, nobody's keeping anything from you. Okay. You can hire an accountant. Oh, like me. I'm a CPA. I do people's taxes. That's right. Check me out in the upcoming tax season. There's no secrets, okay? Unless you're like giga wealthy, okay? Then maybe you could get away with stuff. But average business owner, there's nothing special. There's no hidden secrets. But maybe I'm wrong. Maybe Mark KOHLER here is a giga genius. He's going to prove us wrong. So let's go ahead and we're going to watch this at 1.5 speed, unless it's too fast, and see what he has to say.
The wealthy know them. If you want to be wealthy, you've got to know the strategies the wealthy do. This is it. This is a very, very important podcast. We do it once a year. So many families are not talking about financial literacy, talking about wealth, teaching their family about the American dream, getting help from their family members, getting advice from their parents or aunts and uncles, and getting their teenagers or kids in college to be included in the conversation. You're going to be able to take the write-offs, and you don't have to be rich to do this. You're just going to manufacture the write-off, put the money in, take it right back out. You don't have to wait till you're 59 and a half, none of that crap. Welcome, everybody, to the Main Street Business Podcast. And what is going to be today the best podcast you've listened to all year that saved you the...
Okay, you're not going to get rich by optimizing tax strategies. Obviously, it can save you money, but your wealth comes from your business, your employment, investing. Optimizing tax strategies just basically saves you money. That's it, okay? But you're not going to be wealthy just from optimizing taxes. The wealth comes from goods and services you provide to society, or grifting in the case of a lot of YouTubers.
The most money, because saving money is just as important as making money. My name is Mark KOHLER. I'm here with the infamous Matt Sorensen. We got 25 freaking awesome tax strategies to show.
Okay, they're both CPAs, so maybe they're not grifters. I don't know, but just like they look like grifters. Let's see.
It's gonna rock.
Yeah, we're not just influencers talking about this. We are tax lawyers in the trenches doing this every day. We've done the 10,000 consults. We know what works and what's legit and what really matters. So we're going to hit the hottest strategies. Now, we've got more of this. We've got, like, Mark's got his 25-point checklist here. And our law firm, we're doing this with clients. I want to say this. When you go through a tax planning strategy, you might consider 25 things. 8 of them might work for you, but you got to go through the 25. Everyone's different. It's not an easy button. You just get a hit. So we're going to hit these in rapid fire mode. So they might trigger everyone. Maybe every other one is like, ooh, I need to think about that.
Oh, that doesn't apply to me. Oh, that one does. So super important that, frankly, I know some of you listen to this while you're working out or driving. Please set aside the time to put this on double speed and have a piece of paper next to you and go, okay, boom, boom, boom. And then that's your...
Yes, sir. I'm taking notes. Teach me. I don't know. Maybe we'll learn something valuable here. We'll see.
Your notes, those are going to be the notes you're going to have when you have your consultation with your tax advisor. And we're going to give you some resources where you can find, we've got over 100 tax advisors to choose from that speak. Mark KOHLER and Matt Sorensen. They can be very, very affordable. And we have our own tax lawyers here at the law firm that are doing consults and building trifecta. So we'll come to that. I just want you to know we have a resource because some of you are like, well, how do I do this? I can't. We'll get to it. But just right now, it's about identifying.
Yeah, baby. Okay. And there's a lot of stuff you need to do by year end. That's what we're talking about it right now. We were just talking about this earlier. What happens on April 15th is the report card of what you did for tax planning in the year. Okay. Yeah. There's some things you can do after January 1st that'll help you in 2023 tax planning. But a lot of stuff needs to be done by December 31st. So this is the time. This is the time to say, take action now. And
that actually is true. So especially if you run a business, you want to talk to your CPA before the end of the year, because there's a lot of things you can do during the year, the tax year, that once January 1st rolls around, that's basically it. So tax planning actually is important, okay? Especially if you have businesses.
And one last caveat, and then we're just going to take every other one. Okay, let's do it. And I'll give you, you can take number one if you want. All right. So I'll say this also. So many of these strategies aren't about spending money before year end. It's just about maybe getting the right structure in place to deploy the money right after the first, or getting the structure in place so that you could take advantage of future strategies. And we're going to cover like the health savings account. There's a lot of deadlines coming up on December 31st, and the wealthy know them. If you want to be wealthy, you've got to know the strategies the wealthy do. This is it. This is a very, very important podcast. We do it once a year. This is a huge podcast with a lot of listens.
The wealthy don't know. They hire an accountant. Hire an accountant. That's all you got to do.
People try to turn the corner into the new year. Okay, yeah. Number one.
All right, numero uno one, retroactive S-selection on your LLC. Why are we talking about this? This is foundational. Any small business owner, I don't care if this is your main business or side business, you're selling goods or services, operational business, you need to have an S-corporation. If you have an LLC, a lot of people go out and they're like, I have an LLC. I'm going to save on taxes because I have an LLC. No, you're not. LLCs don't save on taxes. But if you have an S-selection on it or you have an S-corporation, that can save you taxes on an operational business. I'll just give a quick example here to give you an idea. If you're making $100,000 a year in net income, Doing an S corporation or an S election on your LLC versus just being a sole proprietor and hitting Schedule C will save you $9,000 in taxes a year. You're not spending any more money. You're not deploying this to go buy assets or get a write-off here or drop it in a retirement account there. This is just structural and running your money in the right way to save taxes. It saves you on self-employment tax.
I mean, he's correct. So basically, an S corporation, you can partially skip self-employment tax. Self-employment tax is Social Security and Medicare. When you're an S corp owner, if you want to take money out of the business, you can reimburse yourself for business expenses. You can pay yourself a salary. You can take distributions, but you have to pay yourself what's called a reasonable compensation. And that reasonable compensation is your wages. You're paying wages to yourself. Those wages are subject to payroll tax. But once you pay yourself reasonable compensation, any distributions in excess of that, they're not subject to payroll taxes. So that is a potential way to save. But your business has to make a certain amount of money because you're paying payroll taxes. You're paying additional payroll taxes you wouldn't pay if you were just a sole proprietor, like, unemployment and all that. And you got to run payroll. You got to file a 1120S, a tax form. You got to file the S-corp tax return. You got to do tax planning. There's costs that come with an S corporation. So if you're like I will eventually be an S corporation, but I don't make enough profit right now to be a freaking S corporation. Okay, maybe when I make, I don't know, 60K in profit, I'll think about it.
You've got to learn the S corporation strategy. I have an S corp. Mark has an S corp. 99% of our small business owner clients have an S corporation. Yeah. It's the number one strategy for small business. That's why it's on the list here.
We're going to move quick. Don't worry about the C corp. Hell no. And keep it.
Yeah, no, C corps are stupid unless you want to be public unless you want to be Apple.
Keep in mind, this is a retroactive S election you're going to make back to January 1st, 2023. Learn the strategy because number 2 is pegging your payroll. So for those of you that are already an S corp or you implement strategy number 1, part 2, because I've got to choose the right amount of salary. Where Matt comes up with this number of $9,000 is reflective of the amount of salary you're going to claim and pay your F word, the FICA. I don't want to pay FICA. So you're going to pay FICA on a chunk and save self-employment tax on the rest. So for those of you that are already S corps, you would be astonished how many accountants that we bump into, we're going to come to our training programs and or we review a tax return, and these people are taking astronomical payrolls that are completely unnecessary. And I know if some of you are a tax advisor yourself, a CPA, enrolled agent, tax lawyer, you're going to go, Mark, reasonable comp. You don't know. I have read every reasonable comp case. I interview prior IRS agents in the S Corporation Center in Chicago. I have been doing over 10,000 S corporations in my life. I know the rules of reasonable comp. I teach reasonable comp. And I'll tell you, 80% of CPAs and accountants are far too conservative on payroll. There is a matrix that we use as a baseline. In 25 years, I have never had a client audited for taking too low a payroll, period. So get over it and learn something new. And yeah, you might have to suck it up and tell your client last year, yeah, we took too much payroll, but I've learned some new strategies. Own it, embrace your client, and take them to another level. They will appreciate it. That's number 2.
And by the way,
yeah, so the IRS is kind of vague. Like, you have to take reasonable compensation. But it's basically the value of your goods and your services that you provide to your S corporation. Because you form an S corporation, you're the owner. You're also an employee of the S. You're an officer and employee of the S corporation. So how to determine reasonable compensation, it's really a case-by-case basis, okay? I mean, they said they have some matrix. They said they weren't audited. If that's true, great. Okay, but it's important that you sit down with the CPA and figure out what your payroll should be before the end of the year. Before the end of the year. Because if you've been taking distributions but you haven't paid yourself payroll, that could be a problem.
Joe Biden himself used an S corporation. I don't think he would be an aggressive person on taxes. He knew he was going to run for president. He has an S corp on his tax return. He saved hundreds of thousands of dollars by using the S corporation tax strategy.
It was incredible. So okay, number 3.
All right, okay. Make a sale and get out of startup mode. For many of you that have started maybe a side hustle, you've got a good income in your day job or a spouse that's working on your day job, and you're like, man, I want to take some write-offs for my business, but I haven't made a sale yet. You get locked into this startup mode where those expenses are going to just mostly carry forward into future years. But the way out of startup mode is to make a freaking sale already. Get some business. Go get some friends or family members that are like, and maybe you need to give them a deal, but get aggressive in getting a sale, because once you have a sale, now you can use those expenses if you've used to start up your business as a write-off, and they could possibly offset other income you might have from a spouse or maybe your day job, and you may be in a high tax bracket.
Love it. And I call it unlocking your write-offs, because many of you may have started a lemonade stand this year. You spent money on education, buying lemons, lemonade, sugar, cups, and set up your shop, but you haven't sold a cup of lemonade. Those expenses are locked down until next year when you have a sale. So go sell some damn lemonade. All right, number 4.
Yeah, there are some limitations to startup costs. Like, there's only a certain amount you can expense, and then you have to amortize the rest. I mean, there's all these freaking complex rules. But basically, if you start generating revenue, you have a business, okay? And if you have ordinary and necessary business expenses, you can offset that revenue with ordinary necessary business expenses. I mean, it's pretty straightforward.
Hold a board meeting in the holidays to write off travel and dining. Oh, this is so powerful. So powerful. So many families are not talking about financial literacy, talking about wealth, teaching their family about the American dream, getting help from their family members, getting advice from their parents or aunts and uncles, and getting their teenagers or kids in college to be included in the conversation. So at Thanksgiving dinner, which could be a write-off, literally. We've done it for years. We'll take the business card over to Costco and get all the fixings. At the Thanksgiving dinner, guess what you're going to have after the dinner? And maybe during halftime of the football game, I don't know. You're going to have a board meeting. You're going to talk about your real estate investing, your small business, and you're going to put everybody on the board. We got podcasts on this again, blah, blah, blah. LLCs can do this. Corporations can do it. It is so important to have a board meeting. Now you're writing off your airfare to travel to a dinner on a Thursday to have a board meeting. I can't write off 10 days in the Cayman Islands, but you can definitely write off a couple days, 2-3 days, maybe some Airbnbs. Don't stay at mom's. It's not.
I mean, I guess people, you can write off anything. You know, it's the fact of whether it's going to hold up with the IRS. Me personally, I went on Thanksgiving. I'm going to hold a board meeting right after Thanksgiving dinner so I can deduct all of this. Like, I'm not going to say it's illegal, but if you get audited, the court could find that it's BS. So, yeah, you can write off anything you want. It's just if it holds up under an audit. These guys are saying you can do it. I don't freaking know. I've never heard of this. You know, so a lot of people try to get super creative with taxes, and it honestly annoys me, okay? Because, like, what they're basically doing is being sketchy. A lot of people, I use Netflix for research, so I deduct Netflix on my business expenses. And a lot of it's BS, okay? And I'm more of a conservative type of guy, but, you know, I guess if you wanted to deduct freaking everything, and, I took a dump in my guest house. So, I could write off everything. Like, go right ahead and freaking do it. But it's all about whether you can, you know, survive an audit.
Worth it. Stay in Airbnb.
Yeah. Because now it's a write-off.
Now it's a write-off. Mom, I need the write-off. Sorry.
Yeah, for that.
You're not going to stay with me? No, I need the write-off.
That board meeting held on a Thursday.
Yes.
I mean, you could just, a tax deduction, you'll save more money just not incurring the expense unnecessarily. If you spend $100, that's a $100 deduction or write-off. But that only saves you up your tax bracket times the deduction. Whereas if you didn't spend the money at all, you would save all the money. So you don't have to spend money for no reason because it's better just to not freaking spend money. If you spend money, if you have to, it's preferable you can deduct it, but you don't have to spend money.
All right, okay, next. Get a health savings account already. Okay, we all have medical expenses. For the most part, okay? This could include your dental too, prescriptions, out-of-pocket medical expenses, and they're not a deduction, they're not a write-off. A lot of people track these, and they send them their account, and their account's like, you can't write it off. You make too much money. You make too much money. It has to exceed a large amount of your AGI. What is it, 7.5% of your AGI? It's got to exceed that before you can even deduct $1 of medical. So most people are not able to deduct their medical expenses. But if you use a health savings account, you put your money in the health savings account, you get a tax deduction. That money can be invested and grow. By the way, you can self-direct it too. A lot of amazing strategy we teach. But when that money comes out, it comes out totally tax-free for qualifying medical expenses. It's a way to deduct and get a deduction for the medical expenses that we are all going to use. So
I mean, yeah, that's true. I don't personally have one. I don't have a high deductible health plan, and I honestly don't spend a lot on health care.
Use the health savings account, and it carries forward too, right? This is one of those things where it's not like that flexible spending account, whoever's use it or lose it. If you don't use it, it stays invested and it can grow, and you can take it out later for qualifying medical.
So the year-end tip here is you don't need to put money in an HSA. You don't need to open up an HSA. You have to have a high deductible healthcare plan to do an HSA next year. And right now is open enrollment. You have from November 1st to January 15th. If you don't implement a high deductible plan, and some of you, they're going through enrollment at your day job. Walk in and go, hey, I'm pretty healthy. I want the HSA plan. That's all you need to know right now, people. Choose.
I mean, if you're like single and healthy, sure. I don't see an issue. But like, if you have kids or you got a lot of medical issues, well, guess what? That high deductible plan might suck because you have to meet the deductible before the health insurance kicks in. So you might be dropping thousands of dollars on medical expenses before you can even get covered by insurance. So I personally have a military health plan, and I'm more of a fan of not having a high deductible health plan because I have freaking kids and all that garbage. Well, they're not garbage, but yeah, I mean, it all depends on your personal situation. But yeah, I mean, HSAs can save you on taxes, definitely.
Use the HSA qualifying plan. The deadline is upon us. Then next year, you're going to be able to take the write-offs, and you don't have to be rich to do this. You're just going to manufacture the write-off, put the money in, take it right back out. You don't have to wait till you're 59 and a half, none of that crap. So look for your HSA plan. You've got to do it in the next 6 weeks.
Yeah, and if you're single, that's $3,850. Family, which could just be you and a child. It doesn't have to be you and a spouse. It doesn't have to be, the family of four type name case. You can get it in many ways. It's $7,750 you can put in a year. And right now, you could drop that in right now, and then again, January 1st. But we're going to get the deduction
geared up for next year.
For next year. But anyway, so we're looking for 2023 deductions. You actually have until April 15th. I don't want to confuse you, but I'm just saying, you're going to be able to do another year's worth of contributions in just a couple months.
Yep. Okay.
This is just an example of like, yeah, it can potentially save you on taxes, but do you want a high deductible health plan? Do you have a lot of medical expenses? It's not just, just do it, bro. It's not that easy.
Number 6, dissolve or set up any entities you need. Now, right now, we're on the cusp of the new Corporate Transparency Act. If you haven't heard about that, we just did a podcast last week on this, or 2 weeks ago. You're going to be hearing a lot more from us on this. The point is, why keep an entity around that you don't need? Something you're maybe paying state filing fees or franchise taxes on, or now paying to get it in alignment with FinCEN, the Financial Crimes Enforcement Network, under the Treasury Department. They are now requiring reports next year. So if you have an entity that you're not using, kill it. Also, some of you are like, oh, I loved your S-corp idea. I don't even have an entity or an S-corp or anything like that. Get it set up now so it's effective January 1st. So what you're doing is cleaning house. This is so important this time of year. So you're ending the year strong with any entity you got to get rid of, and you're starting the year strong with any company you need. Now, again, I'm going to give you resources here at the end of the podcast where you can go for help if you're like, oh, well, I'll just go to LegalZoom and do it. Slow on, Tiger. We got 25 freaking strategies. I don't think going on Google for 3 days and trying to figure it out on your own is the best use of your time.
Yeah, I would use a lawyer or something. I would not use LegalZoom. Oh yeah, I mean, I'm gonna design my entity using LegalZoom. Because I'm such an expert on taxes.
Get you an advisor for just an hour or 2 to help nail this. Dissolve or set up entities.
All right, next strategy, flexible spending account. Now, I mentioned this briefly when I talked about HSAs. We love the HSA over the flexible spending account, but many of you might have a job that offers a flexible spending account, an employer. You can do $3,050 a year into this, but remember, put in there only what you're going to use. Think of this as a strategy to drop money in, you're going to immediately come back out on. And so, because it's use it or lose it type strategy, we don't want to lose it, but it's $3,000 a year, you get a tax deduction, got to do it by your end.
Yeah, and where this is important is if you're part of an FSA at work, they're putting something in for you. They wouldn't have it if they didn't. So they're going to be putting in $100 to $3,000, depending on your level in the company. So a flexible spending account is a use it or lose it. You've got to turn in your receipts before year end. There is a makeup provision for a certain portion of it before April 15th, but you don't want to deal with that. So what are you looking for? Receipts for prescription drugs, eyes, dental. The list is 502, publication 502. The list is extensive. All that Viagra you were buying over the counter, you can write that.
You can't get it over the counter. I had to get a prescription for it.
Gotcha. Oh, you did?
Oh, you got me. Hey guys, talk about tax-free growth. All right,
woo!
You know,
I love it. Nailed it. That was my joke, by the way, but I take some of yours.
Man, schlong jokes. I like it.
Okay, so yeah, if your tax deduction lasts more than 3 hours, call your doctor and your CPA. Okay, now here's the deal. Medical is a huge option to get some write-offs before you're in with a flexible spending account. What I've done before is I'll go around to the pharmacies that I might frequent, the grocery stores or wherever, CVS, Walgreens, and go in and ask, can I get a report of what I paid for this year? And they'll give you the report. Then you just take that into work and go, use it or lose it, and they'll write you a check. So that's the flexible spending account strategy. We don't recommend implementing one for a small business owner. Again, this is for those of you that have one at work or your spouse does. Use it or lose it. Stick to the HSA. We're going to come to the HRA here in a minute. Okay, number 8.
all right, thank you.
Sure, no comment on that.
Kids under 18, amazing tax strategy. If you've got a small business or even a rental property, you should be getting your kids involved in that business or rental property, teaching them, get them involved, and pay them for it. You get to take an expense for that. You're in a higher tax bracket. They're in a no tax bracket, all right? That is a write-off for you, and you're going to pay them under the standard deduction, so they don't even need to file a tax return. Now, we've got other podcasts on this, on how to do it properly. If it's an S-corp, you got a little 2-step method with a family management company. So you want to make sure you're doing this right. But step 1 of this, and there's another little twist to this I love, you know. But I'm a little free.
Go ahead. You can
I'll leave it for you. Okay, I'll throw it down too. But once you pay your kids, don't just give them the money. Put it in a Roth IRA. We have a kids Roth IRA, a directed IRA. Put it in a freaking Roth IRA for them and teach them not only how to work and make money in your business, but then how to invest it. And let them have a Roth IRA starting in their teens or even earlier. Talk about the growth that can have over 30, 40 years. It could be pretty phenomenal.
Yeah,
The thing with that, I mean, yeah, you obviously, if your child is actually doing work in the business, sure, you could pay him, okay? But you got to be careful with just, I'm just going to pay him up to the standard deduction. So they don't have to file a tax return, and I'm going to take the full deduction on my business. It's basically, transferring tax from you, higher tax bracket, to the child. With standard deduction, they don't pay any. But, they actually have to be doing work. Okay, you can do, these are all like legit in a sense, but they actually have to be legit. Your child actually has to be doing work. It can't just be a grift, basically, because you can get in trouble. I mean, you can deduct whatever you want. It's all about whether you can survive the IRS coming after you. That's the big thing.
That's the legacy you want to leave.
That's the legacy. And I'm not kidding. In our family board meeting, a couple times over the last few years, we have talked about the Roth IRA in our family board meeting and watched a Dave Ramsey video on the power of compounding interest. Dave Ramsey just does a phenomenal job on that video. I've done the same speech. I think I'm pretty good too, but it's just, my kids don't want to hear me. So I turn on Dave Ramsey. So whoever your flavor of the month is, get that education in front of your kids at the board meeting. And be careful. We're not talking about issuing W-2s or 1099s to your kids under age 18 as well. You've got to know the strategy here. And if you call up your accountant and go, I want to pay my kids under age 18, and the word W-2 or 1099 or you can't do this comes out of their mouth, would you fire your freaking accountant? Holy crap, this is such a common, well-used, respectable, legitimate strategy. I have never in 25 years had a client audited for putting their kids on payroll in the right method, ever. So please, accountants, if you're out there, learn this. Get over it. Get to my Certified Tax Pro Network at markjkohler.com and get certified in these strategies. I'll send you clients all day long that want you. All right, number 9. Oh, man, this is nothing.
You want this one for me too? Solo 401k?
Yeah.
I do love myself a solo 401k.
Oh, so do I. I got one. Woo, baby. I got my Roth solo 401k. Oh, it's juicy. I love it.
All right, any of you self-employed, solopreneurs, you have no employees. It's just you, maybe a spouse, business partner, family members. You can do what's called a solo 401k and put $66,000 a year into this.
Up to.
That's the total cap.
If you make enough money to do that.
But this is 10 times what you can put into an IRA. You can put $6,500 in an IRA right now for 2023. In a solo 401k, you can put $66,000. Now you need to be making the money to drop that in. You can't just making 10 grand a year and put $66,000 in there. But if you're making the money, that'd be about 180 grand approximately to max it out. You could conceivably put 66K a year in it. Now, if your spouse is involved in the business, you can also drop 66,000 a year in for them. For a lot of our clients that are self-employed, making a lot of money, they're like, all right, I need some year-end write-offs. This is one of the big ones I go to. And I'm like, is your spouse involved in that business? Yep. All right, we can almost do 100 grand in this thing, 1 year of contributions. And if you want to go traditional, it'll be totally tax deductible. You get a write-off. If you want to go Roth, because you have some discipline and you want all that money starting to grow and come out tax-free, you can go Roth. But a solo K is an amazing strategy. You can self-direct.
I 100% agree with this. You actually, as a business owner, have huge advantages when it comes to 401k. Because, like, if you go to a job, right, you go to a regular W-2 job, you can contribute up to the statutory maximum, which I believe is $23,000 this year, and then the remainder between the 23 and the 66 is what your employer could potentially match. So the match doesn't count against your contribution limit, but there is a total limit. But if you own your own business, you are both the employer and the employee, so you can match yourself. And that's how you get up to the 66. So they're 100% right. And I'm actually excited about this because if this business ever takes off, ooh, my man, put so much money in my 401k. Oh, it's beautiful.
Direct it. So many bells and whistles to it. It's for you solopreneurs out there.
And this is what the wealthy are doing and considering. And again, you don't have to put the money in before year end.
Okay, I mean, this video's better than I expected. I thought these were going to be like two grifters, but I mean, they are CPAs, or so they claim, so. And it seems kind of legit so far. I mean, some of their tax strategies, you know, can be ambiguous, but it's not like total scam.
You put it in up to 9 months later, next year, and get the write-off for this year. If you have the solo 401k set up. If you don't have it set up, you can't play in the game. So, fully, they're under the
Secure 2.0.
Secure 2.0. They did provide some options for a 401k. It's not the full benefit.
Yeah, it's the employer contributions, basically, but you don't get to max out the employees.
No, so the full 66 is going to be elusive if you don't get it down right now. So get the solo 401k. We have a special this time of year. Call the office. But if you don't have it set up by December 15th, the IRS, you can't get an EIN during Christmas to New Year's. They shut down for service. You're not going to get the solo 401k. So call right away. We have a docs only and an attorney consult version, very affordable, and you get to self-direct that solo 401k and invest in whatever you want. Notes, real estate, crypto, small business.
No, VT.
Syndications. All right, number 10. Kind of more common. A lot of people think about this. How many of you have driven by a farmer's house and the barn and seen all this crap out there on the field just gathering rust? It's because farmers hate the government. It's like they're part of their DNA. They hate paying taxes. So what they'll do is they'll go buy a new John Deere on December 31st to not pay taxes. Now, what's akin to this is a small business owner that's like, hey, I could use an SUV. I could use a truck. Or I'll tell you, the auto deduction strategy has gotten hugely more beneficial under the Tax Cuts and Jobs Act. The biggest increase in the auto deduction in over 30 years was just at the beginning of Trump's presidency, and it's still in effect. So be thinking about, do you need a new vehicle before year end? We're going to talk about equipment later, but just a vehicle. Don't go out and buy something you don't need, but this could include an electric vehicle, the Teslas or others that give you a tax credit. This could be a tax deduction with depreciation or bonus, all sorts of options. I've got an article on my site on this. Go check it out.
There's a ton of rules about deducting vehicles or taking like depreciation, bonus depreciation, all that for vehicles. It all depends on the weight and this and that. But my only advice for this would be, if you don't really need a vehicle, don't freaking buy one for the deduction and the credit, because you're still spending money. Okay? If you really need a vehicle, then maybe you can talk to a CPA or you can talk to me and figure out the best option for you and how much you can deduct for basically accelerated depreciation in the tax year. But don't just go buy a vehicle, just buy one, okay? It's like you don't want to just purposely seek write-offs just to seek them.
We've got podcasts on it. Be careful.
Yeah, this could be a December to remember.
Yeah.
For your tax deduction, all right? And there might be an automobile involved in it as well.
Now we got a sexy one here. Everybody hates this one.
This is a sexy one, but this is kind of like, if you want to get shredded,
that's right.
It's about the kitchen. It's about what you're
like me.
eating. It's not just about how much time you put in the gym, it's about what you're eating. And in the tax planning world, this is bookkeeping.
Yes.
It's about what you're tracking.
How can you make a decision in the next 4 weeks?
Exactly.
If you don't even know what you got.
If you don't even know what you have, how are you? And by the way, how do you know what's going on in your business so you can make great decisions? If you're not tracking your income and expense and your books are a mess, you're lost. Okay, you don't know where you're going. If you don't even know where you...
I 100% support this. People's books are a freaking disaster. You need bookkeeping. You need a bookkeeper, and at some point I will offer this. You need a freaking bookkeeper to set your books clean, because you don't know what the heck's going on in your business unless you have your books clean. And it really saves you time on tax prep, because if you just give me a bunch of stuff that I have to figure out, it's going to take longer and I'm going to charge you more. But if you have clean books, it's actually really easy to do your taxes.
You've been, how do you know where the heck you're going? Now, what I see, and this is my own personal experience, in years I've been off on my books, and then you're trying to figure out, all right, was that a write-off? Was this a non-write-off? I have this personal account over here. I can't remember. I swear I spent this here at Costco, and when I was there, I picked up a laptop or this thing I used in my business. Okay, don't get yourself caught up in that. And was this mail business or was this personal? I can't remember. Track it. The clients that save the most money, that have the most expenses, are the ones that freaking track it. They don't miss anything. Yeah. And so by having good bookkeeping, having that set, having a process where you have a third-party bookkeeper, family member doing it, yourself, whatever your process is, you've got to have the process and be really just about getting it done.
Yeah. So what's the year-end tip here? Before you make some of these other decisions, at least do an estimated profit and loss. Do an estimated balance sheet. What is in my traditional accounts? Because we're going to come to Roth conversions here in a minute. There's other important deadlines. People, we're only on number 11. We got 25. We got to keep burning here. But the point is, in order to make an informed decision, at least do some ballpark books. Now, you might want to hire a third party right now. Get on Thumbtack, Fiverr, Upwork, Facebook Marketplace. Find a bookkeeper and say, I got to drop this off. You got 48 hours. Come up with something. Get your QuickBooks reconciled just so you have a good idea. Because some clients are like, oh, I need write-offs. We do the books. I'm like, you're fine. Oh, I thought I made more money. Other people are like, did the books. Holy crap, I've got that much income. But they don't find out until February, March. Find out now. Okay. Number 12, shift income and expenses. Again, fairly traditional conversation. Even the most conservative accountants will talk about. But we got to talk about it. And that is, if you've got some expenses that you know you're going to make in January, maybe you're buying some new computers, some new laptops, some new cameras, some new tripods. You're going into the next quarter buying some more equipment for your business expansion or whatever. You can put it on a credit card now and take the tax write-off now. So going out and buying some of these expenses right before year end on credit, because you know you're going to buy them in January anyway. I'm not saying go into debt. I'm not doing any of that. And if you have a business line of credit that you use for operational expenses, if you could dump in 10 or 15 grand in write-offs or more right before year end. This is where doctors will be like, oh, I need that new MRI unit, or I need this new x-ray this, or I need this new that. Or again, a farmer saying, hey, I need this repair done, or I need this new pipe, or I need that. So go out and do a survey. If you're going to buy it in the next 10 weeks anyway, go pull the trigger. Same with income. You may say, ooh, don't pay me till January, please. And so people that owe you money that might be on accounts receivable, that can be dangerous. You got to be careful, but you might want to bounce and say, I'm going to push some income to the next.
Yeah, I mean, the expenses thing is okay, but like, oh, just don't pay me. Like, that gets a little sketchy, okay? Because like you're basically, you are deferring income, and the IRS may not like that. So be a little bit careful. Let people pay you when they freaking pay you, okay? Don't get involved in trying to shit. Oh, don't pay me until next year. No, just be careful with that.
To the next year, and have those people write the check and you go pick it up on January 1st. So shift some income, shift some expenses. It could really swing 20 to 50 grand one way or the other. Yeah,
I think most small business owners should be on a cash basis for their accounting of this. And that's where it is really important. When did you receive it? When did you pay it out? That stuff matters because that's what's going into your books and your bookkeeping.
And that's the cool thing with credit cards and cash basis taxpayers. You get the best of both worlds. So it's super cool. All right, HRA, health reimbursement range. We talked about the HSA a little bit earlier. HSA is a lot more common, I would say. But for some of you who are like, Matt, how much can I throw on that thing? 7 grand, 7,750 family? I got 20 grand in medical. I had a knee replacement. I put my kid in rehab. I had eye surgery. I had LASIK is a write-off. Yeah, so huge.
Family member go to rehab. I mean, I don't know. It's gonna be a lot of things that come up that could actually be an HRA. And if you own a business, you can do what's called a health reimbursement arrangement in the business. We're gonna get a larger amount that you can write off. And there's a strategy on how this works. We got a whole separate podcast on this. You want to have one of our tax lawyers set it up, or someone that knows this to get the HR set up. It's not like an account you go set up at your bank, or that you're gonna do like it directed. This is an actual plan documents established. But the general point of this is, if you have high medical, and you're like, guys, that $7,700 a year is not cutting an HSA. I've got really high medical, and I'm going to have it year after year. You need to be considering an HRA. This will get you a bigger write-off. You can go over the $7,700 a year annual contribution, but you can pull back out.
It's unlimited for small business owners, this type of HRA. There's QS HRAs and all this when you have more than one employee. But for you solopreneurs in a family, these are incredible. I would just say this. This is where you need a consult, again, before you're in, to adopt the plan. You can retroactively adopt the plan for the year, do some reimbursements. This is a part of an overall medical strategy. So let me summarize with this. Health savings account, flexible spending account, health reimbursement arrangement. You can have all three. It depends on the makeup of your family, your income, and your business. So bring that up in a consultation, and where you can, because if you have low expenses anyway, an HRA is not going to matter to you. You're going to be all HSA. You have high expenses, you might double dip in the HRA and the HSA. Oh, your spouse has an FSA at work, we're going to tap that out. So it's going to be a combination of different strategies based on your situation.
I think the conclusion here is, if you're running a business and it's very profitable, you need to talk to a CPA. Like me.
All right, next. All right. Paying kids 18 and older.
Ooh, you want to pay your kids 18 and older? Still get them involved.
No, I do not want to pay them, but I end up paying them.
Yeah. Hey, you know what? Some of them are actually worth it. And
that's true.
If you're paying your kids to get them involved in your business when they were teenagers, they're actually be worth something by the time they're 18. Right? And you still want to get them involved, right? And I've had my kids do social media stuff, go to events for me, my bookkeeping, and I want to pay them for it, right? and I'm going to get a deduction. I'm going to get an expense. I'm going to 1099 them though. The strategy is changing now. I'm going to 1099 them because they're over 18. The rules change here with how this is the tax code. Okay.
Different rules for the under age 18. That was strategy number 6. Paying the kids under age 18, whole different ballgame.
If they're over 18, I'm going to pay them. I will 1099 them. I'm going to expense that. I'm in a higher tax bracket. The kids might be in college or they're getting started in a career or a business and they're going to have lower income. They're going to pick that up as income.
Yeah.
They will pay self-employment tax on this, of course, but they're going to be in a much lower tax bracket. And
They're going to have write-offs to go with it too.
and they're going to have write-offs. You know, I've done this with my kids too. Again, I end up helping them on their tax returns. So they, you know,
At this time of year, you're also thinking of stocking stuffers. And what can I get my kids for Christmas? Put the 1099 in their stocking. They really appreciate it. It's a lot of fun. They'll really enjoy that. And play with it all, spring until April 15th. Now, on this note too, what are the kids doing? Okay, let's get clear. Many of us parents still help our kids from time to time once they're 18 and older. Oh, my car broke down. Oh, school tuition. Oh, bought this new thing. Whatever. I need some help, Mom. I need some help, Dad. Why are you writing this off? Because they're on your board of directors. They're on your board of advisors. Go back to the strategy number whatever, where we're doing our board of directors meeting in Thanksgiving. Now you have a
That's so cringe. Why would you ruin a Thanksgiving with a board of directors meeting?
legitimate purpose and reason for paying them, 1099ing them for the crap you gave them anyway, because now they're on your board. See how this all comes together? Very legitimate, very common, doable. We've been doing it for years. Get your kids 18 and older on the board of directors at Thanksgiving, and now you've justified the 1099 for any money you've given them. All my kids know, if they ask for money after age 18, they're getting a 1099. They do. And they're like, oh, you want help? They're going to get a lecture and a 1099. Now, I've got some of my kids working in my business legitimately, and they're phenomenal. But sometimes they need some help,
Yeah.
So,
and of course, this does qualify them for a Roth IRA. Maybe they're college kids, and so they didn't need the income or whatever. So they're and
That's so odd. Why don't you just gift them the money? Oh, hey, mommy, I need my car repaired. Oh, you're on my board of directors, so I'm going to 1099 you. I don't know, that just seems sketchy to me. I don't. Maybe this is legit. Okay, these guys are like, there's certain accountants that are super aggressive. Like, they'll just, every deduction, you can deduct this and you can deduct that. And then there's accountants that are like in the middle, like, oh, I got to be careful and watch out for this. And then there's conservative. It's all about how your CPA's personality is, their degree of risk they want to take, and the likelihood that you can be audited. That's what it all comes down to, is if you're audited and whether the IRS will find out if you're BS or not. So at this point, I'm going to cut off this video and I'll finish the second half maybe later. But yeah, so far, I mean, I guess most of it seems pretty legit. These guys seem super aggressive, but they're confident and they're well kept, so I guess I can trust them, right? Anyway, I hope you enjoyed the video. If you want a sponsored video, see the pinned comment below. Check out my book, Stop Being a Broke Loser. Check me out if you want me to prepare your taxes for this upcoming season. I'm a certified public accountant, and I'll talk to you later. Cheers!